Hello everyone, good evening. Welcome to the Q2 FY26 earnings call of Delhivery Ltd, hosted by Ambit Capital. Before we start, Delhivery would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. Kindly note that this call is meant only for investors and analysts. If there are representatives from the media, they are requested to kindly drop off this call immediately. To discuss the results, I am pleased to welcome Mr. Sahil Barua, MD and Chief Executive Officer, Mr. Amit Agarwal, Chief Financial Officer, Mr. Ajit Pai, Chief Operating Officer, Ms. Vani Venkatesh, Chief Business Officer, Mr. Varun Bakshi, SVP and Head of Part Truckload, Mr. Navneet Kumar, SVP and Head of Supply Chain Services, and Mr. Vivek Pabari, SVP and Head of Corporate Finance and Delivery. As a reminder, all participants' line will be in listen-only mode, and participants can use the raise hand feature to ask any questions post the opening remarks. Now, I invite Mr. Sahil Barua to take us through the key highlights of this quarter, post which we'll open up for Q&A.
Thank you, Dhruv. Thank you, Ambit team. Welcome to all of you who've joined, and thank you for joining this evening. As always, we'll begin with a short presentation and then take questions. But before we begin, as some of you are aware, we've been in the process over the last couple of quarters of rejuvenating the delivery board. As part of this, Mr. Yashish Dahiya from Policy Bazaar and Professor Padmini Srinivasan joined our board last quarter. In this quarter, as you would be aware, Mrs. Aruna Sundararajan will be stepping down from the board of Delhivery. On behalf of the entire management team and the board of Delhivery, I would like to extend our deepest gratitude. Mrs. Sundararajan has been on the Delhivery board for the last 3 years, and we benefited immensely from her guidance. Also, I'd like to congratulate formally Mr. Vivek Pabari, who will be taking over from Amit Agarwal as Chief Financial Officer of the company, and also place on record our gratitude to Amit. Amit has been one of the longest serving members of the delivery team, having joined us on the 4th of August in 2012, and playing the role of CFO with great distinction, and also the key architect of delivery going public. Going forward, Mr. Pabari will be leading the finance function. He's already the head of corporate finance and investor relations. As a brief summary of the quarter before we begin, this has been a quarter of tremendous growth for the company. As you can see, we completed the acquisition of Ecom Express in Q2, and Express volumes have grown 32% year on year. We broke several records along the way, crossing over 100 million transportation orders in September, which has continued in October, and also reached our peak dispatch of 7.2 million orders in a single day during this festive peak period. The particularly heartening part is that these records were achieved also with complete operational stability, which has essentially given us an excellent base for Q3 in both the Express and the PTL businesses. Profitability of the core business has also remained absolutely stable, despite a shift in volumes due to the GST period. And overall, from an integration standpoint with Ecom Express, we will recognize in this quarter about 90 crores of integration costs, and are well within our overall envelope of 300 crores as we had guided towards at the time of the acquisition. To take you through the presentation, I'll invite Vani, who is our Chief Business Officer, to sort of go through the highlights of the quarter. Vani, over to you.
Thank you, Sahil. Thank you, Dhruv. I'll quickly run us through the numbers. So our revenue from services came at about 2,546 crores this quarter. That's a significant YOI growth of about 16% and a quarter growth of about 11%. This came in with an EBITDA of 150 crores. Again, massive jump. Bear in mind that this quarter also takes in the peak related costs. So compared to Q2 last year, where we had about 57 crores, this has jumped up to 150 crores. So that's a 5.9% on EBITDA margin. Our express parcel shipments showed significant growth. We ended the quarter at about 246 million express parcel shipments. That's a huge 32.5% growth YOY and 18% growth quarter on quarter. PTL continue to demonstrate stable, steady growth. It's at about 477,000 tons. And overall, we ended the quarter with a PAT of about 59 crores, which is 2.2% compared to the same quarter last year, where we were at about 0.4%. It's a significant jump in the number of basis points in the profit expansion agenda that we had. The same reflects in H1 as well, 4,840 crores of revenue, which is 11% YOY growth. We had a 299 crores of EBITDA, again a 6.2% EBITDA percentage, 453 million of express parcel shipments, 935,000 tons of PTL freight tonnage, and 150 crores of PAT. Our cash and cash equivalents keep us in a comfortable position. We are at about 4,200 crores of cash and cash equivalents as we end the quarter. Yeah, if you can move a slide forward. Coming to our key operational metrics, our PIN code reach has been consistent at 18,830. We've increased the number of active customers significantly. Same time last quarter, we were at about 38,000. That's a 10,000 increase from there. Same time in Q1, we were 43,000. So again, a 5,000 increase from last quarter. Infrastructure, we've expanded to about 22.05 million square feet. A small part of it is for peak related, but overall it's shown a little growth. We have about 123 gateways, 50 automated centers, slight increase in each of these counts. Sorters count has slightly increased to about 74. Freight service centers has increased to about 141. Processing centers have been largely constant at about 160. Our express delivery centers and partner centers together are at about 4,600, 4,700 odd. So that's shown a slight increase, including a little bit for the peak. We've had a team size of 75,000. Again, you see some increase, which is peak related, and partner agents of about 64,000, managing a fleet size of about 18,600 odd fleets, right? So that's roughly the operational metrics that we are at. If you can move forward. From a performance point of view, our revenue from services, as I mentioned earlier, is about 2,546 crores. It's a healthy 16% YOY and 11% QOQ growth. You'll see that the contribution of Express has scaled up to about 63%. PTL has been largely stable in the 21-22% range, right? And the rest of the businesses continue to grow profitably. Our express parcel revenue grew about 24% YOY, and the tonnage grew about 32%. So we ended up delivering about 1611 crores in express parcel via 246 million shipments. Again, this was a very healthy all-round growth. We obviously benefited from the acquisition that we had. In addition to that, there's been organic growth as well. And we've seen growth across segments, be it the e-commerce players, be it the D2C players, or be it parcels from small businesses. We've seen all-round growth in this segment. PTL, again, freight revenue grew 15%, got about 546 crores, and the tonnage has grown about 12%. So PTL freight revenue continues to trump tonnage, which means it's coming in at a very healthy yield. So the team has diligently been expanding the margins here and making sure that it's a profitable growth. We can move forward. Coming to supply chain services, we'll find a blip in the revenue. The revenue is at about 170 crores. This is a very calibrated, conscious blip, as we explained during the last analyst call also. We've been careful about what contracts to be in and what segments and what industry sectors to be in. And as a consequence of that, you will see in the subsequent section that the profitability has grown quite substantially. So our idea is to make sure that we have a very healthy profitable mix, a profitable construct which we can scale this business up to. So supply chain services, from a revenue point of view, you will see that it's a calibrated drop of about 14% YOY, and you'll see a significant increase in the margins in the subsequent page. FTL service ended at about 150 crores in Q2, and our cross-border services ended at about 38 crores in this quarter. If we can move down. From a service line, if you look at it from a service line profitability point of view, I call your attention to the box which is shaded Q2FY26. So overall revenue from services, as you see, is about 2,536 crores. Our margin percentage has been at 13.2%. Bear in mind that again, Q2 is a quarter where we have made peak-related investments. So compared to Q2FY25 of 9.3%, there's a significant expansion in margin of about bringing it to about 13.2%. Again, express parcel margins are again at about 246 crores, which is a good 15.3%, stable, similar to a slight increase from Q2 of about last year's Q2 of about 15.1%. If you look at part truckload, again, it's a 8.5% margin. And notice that in part truckload in the first half of FY26, we've clocked in about 100 crores of margin, which is equivalent to the full year last year. So very much in the right direction, yield increasing, and we are looking forward to significantly more expansion in the coming quarters as well. Similarly, supply chain services, it's been a solid story from a profit orientation point of view. The business has been pivoted to good profitability. You will find that it's scaled up from 7.2% to about 12.8%. And if you look at the same time last year, same quarter last year, it was at a negative 4.4%. So it's been a significant focus, concerted effort to take it from a negative 4.4 to a 2.1 to a 5.4 to a 12.8% this time. So again, if you look at the absolute margins, which is at about 22 crores and 15 crores in the last quarter, this half itself, this business has done about 36 crores has clocked in about 36 crores of margin, which is almost twice all of last year. Right. So overall, if you look at the core businesses, we are in a very healthy state. Our core businesses are growing healthily. The orientation towards profit has been solid. All the metrics are in the right direction as far as the core businesses are concerned. Coming to corporate overheads, our corporate overheads have been at about 9.3% as a percentage to revenue. It's largely in the same ballpark range, 9.1 to 9.3%. We've seen some increase in wages, and we've put in some investments in technology, as well as tech also sees a little bit of uptake on account of peak and the volumes related to peak. But overall, it's still at a 9.3% and in the right direction. As far as investments in new services are concerned, as we discussed last time during the analyst call, we've invested in two new businesses. One is the rapid commerce business, where we do a sub 2-hour same-day delivery. Currently, we are present in 3 cities through 20 dark stores, and that business continues to scale up well. The other one is an on-demand intra-city service, where we have initiated operations in Ahmedabad, Bangalore, and NCR. Both of these businesses continue to scale well, and our investment this quarter has been about 15 crores in these businesses, in line with our plan. All in all, our adjusted EBITDA ends at about 83 crores for this quarter, compared to 10 crores in Q2 FY25. So we've scaled it up from same time last year, from about 0.5% to 3.3%. And we've good line of sight for similar expansion to continue. Also to be borne in mind is that this has been a unique year where some of the peak related benefits will actually flow in October, given that the peak festive season actually started at the tail end of September. If we look at the profit after tax trajectory, our profit after tax has again shown consistent expansion. Overall, for Q2 FY26, we've clocked in 59 crores of PAT compared to 10 crores in Q2 last year. So again, a significant movement. If you look at the overall trajectory from about minus 4.4% in Q1 FY24 and minus 5% in Q2 FY24, it's jumped last year to about 0.4%. And again, it's jumped this year to about 2.2%. So the focus on profit expansion and the focus on scaling up business with the right levers has played well for us, and we are very, very well positioned for the upcoming quarters. Quick update on Ecom Express acquisition. As you know, acquisition was completed on July 18, 2025. We paid a final purchase consideration of about 1369 crores. Business-wise, the volume manifestation at Ecom ceased during the first quarter, with non-express businesses exit being underway. Now, with the revenue transition largely completed, net Ecom revenue for this quarter was about 13 crores. Network rationalization plan has been completed. We've retained 7 facilities with about 1.3 million square feet of area. There are unabsorbed facilities still leased at Ecom, total to an area of just 1.1 million square feet, and they are primarily servicing Ecom's non-express businesses being exited. Financially, monthly corporate overheads at Ecom have reduced by 85% from deal announcement time till end of Q2 FY26. Assets worth 100 crores have been retained on Delhivery consolidated books for long-term usage, and integration cost was about 90 crore in Q2 FY26. It's well within the original estimate. So overall on Ecom, we are quite happy on multiple counts. One is from a customer retention and a revenue retention point of view. We had indicated last time that our business case was based on having about a 30% retention. We are well over that. So that's one. The integration has been seamless. We haven't had any issues from a service or a customer integration point of view. And the integration costs are also well within our original estimate. So all in all, it's been a good seamless transition. Coming to the working capital, we've demonstrated continued improvement in working capital. In particular, there's been very disciplined management of collection. There's been tech usage in claims and disputes resolution, all of which is translating in the numbers that you see on the page. So as of now, we are actually at under 20 days, which has been the best ever in terms of net working capital days. And we also been calibrated in our capex spend and in our capex intensity. So if you look at H1 FY26, we spent about 5.1% compared to 6.6% same time last year. And typically, we've seen that the investments are heavier in H1 compared to H2. So we expect to end the year even better. And we are directionally trending in the right direction with our long-term goal of getting to about 4% capex intensity. So that's on the capital expenditure. Overall, in summary, it's a highly positive quarter for us. The integration has been successful. The volumes have trended up very positively, and most importantly, we are very well set up for the subsequent quarters. Some of the conscious calls we've taken in terms of pivoting businesses to profitability has set us up well for the subsequent quarters. And largely, we like where we have landed and how we are set up. With that, I'd hand this over for any questions and answers.
Thanks, Vani. So we'll open the session for Q&A. Anyone who wishes to ask a question can raise their hand. The first question is from the line of Sachin Salgaonkar. Sachin, if you could just also speak about your organization name. Thanks.
Thank you. This is Sachin Salgaonkar from Bank of America. Three questions. First question, again, wanted to understand a bit more on express parcel margins. Last quarter, before the acquisition of Ecom Express, your margins were 16%. Your shareholder letter does indicate service EBITDA margins are expected to be in the range of 16 to 18% by end of 26. So how should we think about it? At the low end, are there no benefits from the potential acquisition of Ecom Express? And at the high end, it's more like a 2 percentage point benefit in terms of acquisition of Ecom. Because one would have ideally thought, given the fact that synergies are high, margins could have, further inched up. Let me pause here and then I'll move on to other questions.
Sachin, why don't you go ahead and ask all three questions? I'll answer them together.
Got it. And of course, a small follow-up in this question is what you guys are saying from a next 24-month kind of a margin perspective. Is that a conservative way in terms of, Sahil, how you guys are looking at it, or, the one should think about an upside risk to that? So that's the first question. Second question, wanted to better understand about the 300 crore kind of envelope in terms of integration cost you guys talked about. Ideally, in acquisitions, we do see these costs being front-end loaded versus, distributed over a few quarters. So any broad understanding or color in terms of how we could think about this entire distribution of 300 crore cost? Because this quarter we did see a 90 crore cost. So I want to understand that, is it going to be more back-end loaded or spread across the board? And third, supply chain margin. And while the opening remarks and your shareholder letter did mention about margins, what I wanted to understand is what has changed for margins to move so drastically up, let's say from 7.2 to 12.8. Anything structural which has happened out here? That's where the margins are moved out there. Yeah, those are the three questions. Thank you.
Super. Thank you, Sachin. Let me begin with the first one. In terms of margins, normative margins 16 to 18% in the express business. We've maintained this for a while. This has always been based on the idea that beyond 18%, if the company feels it is necessary and if basis our client conversations, we believe there is additional share of wallet for us to be gained, we typically tend to pass a certain amount of pricing benefits back. As I mentioned in the past, as the competitive intensity in this sector has reduced, number one, number two, as sort of inflation has caught up with other players in the market, the necessity for us to pass on these benefits has reduced year on year. And obviously, with the acquisition of Ecom Express in a more stable industry structure, the need for us to pass this on obviously is lower than before. So there's no structural reason why margins cap out at the 18% mark. Incremental margins are significantly higher than the 18% as we start gaining volume scale. And so realistically, yes, in the express business over time, if we don't pass these benefits on fully, margins can inch up beyond the 18% range as well. Why you're not seeing the uptick in Q2 is for two reasons. One is a reasonable portion of the volume actually has shifted into October because, as we pointed out in the shareholder note, the announcement on the change in GST rates pushed out volumes by about 7 days. And so we carried an extra cost of somewhere about 7 crores because we were building capacity in September. But when we look at the profitability over the September and October timeframe, the profitability for the express business is well in line with our overall expectations. In terms of the next 24 months, I think we believe a couple of things. One is, I think you can see, and this is a discussion we've had in multiple analyst calls in the past 2.5, 3 years, that as industry structure consolidates, it obviously, we believe as the market leader, it consolidates favorably towards us. Our overall volume growth, as you can see, has been 32% year on year. The e-commerce industry has not grown 32% year on year, obviously. So this is market share gain. We expect that our competitive position actually will improve in the years ahead. And so as a consequence, I think, as we continue to gain volume scale in the express business and we continue to grow our heavies business, there is a possibility for margins in this business to grow, first of all, easily, obviously, to the 18% point. And then from there, depending on sort of what we can gain in terms of share of wallet, possibly even beyond the 18%. In terms of the integration cost, the 300 crore integration cost was our estimate at the time that we did the deal. This was obviously based on our assessment of lock-ins on the real estate and facilities, the integration costs of people, and certain contracts that Ecom Express had signed that we needed to wind down. 90 crores of that integration cost has been incurred already. We will have approximately 100 to 110 crores of integration costs over the next 2 quarters. But as things currently stand, our belief is that the total integration costs will be materially lower than the 300 crores that we had originally forecast. We have been able to consolidate the Ecom Express network faster than we originally thought about it. We also have obviously had the benefit of increased volumes, which means some of the facilities we've been able to repurpose and bring into the delivery network productively. So in fact, I think one bulk of the integration costs, or rather for all practical purposes, almost all of the integration costs will be within fiscal 26. You've seen the impact in Q2. There will be some in Q3 and Q4, but beyond there will not be material integration costs, and B, it will be materially lower than what we originally planned. In terms of the supply chain services business, we've discussed this in the past, and the approach is in some senses no different from what we've taken even to the PTL business as we were sort of restructuring it over the last 3 years, which is to first get the profitability of the business right and then to push for growth. So the change indeed is structural. This has come from significant improvements in operational processes, significant improvements in the warehouse management systems. So our technology and our product advantages are starting to show. Also, the launch of our transport management systems, tighter integration with our express transportation and our PTL transportation business and our FTL transportation business have led to improved transportation margins for the SCS business as well. So it is sort of essentially just think of it as significantly improved engineering operations, technology, and product capabilities leading to incremental margins. So that is a structural shift. Now, going forward, I think there are a few growth levers that we have. One, straight away from an e-commerce standpoint, is we have our guaranteed next day delivery product, which is now linked to the fulfillment center network. This essentially is aimed at direct-to-consumer brands and at e-commerce, and we're already seeing pretty decent uptick. Number two, we have expansion of existing relationships, specifically with players who work with us in the auto and auto ancillary space, for example. And we're in advanced discussions with potential clients in spaces that we already serve pretty well, which is consumer durables and industrial goods, and some in the auto space as well. So this change will be structural, and we do anticipate that margins in this space will continue to go up. Last year, of course, our margins in Q2 were particularly affected, and I think we declared a loss of 4.4%, largely owing to our entry at that point into quick commerce, which is a segment that we've exited.
Super. Thank you so much. Very clear on that. Sahil, in terms of GST, again, we saw your comments in terms of what you mentioned on shareholder letter. The question is more from a demand perspective. Are we seeing any increase in demand or a pent-up demand where consumers are buying a bit more because of these GST cuts, particularly on the e-commerce side?
There has been some positive impact of the GST cut on the consumer side. We're seeing it, by the way, not just in e-commerce alone. We are seeing it even in certain parts of our freight business. So there has been some uptick overall in terms of volumes, but it's not sort of, I think it is a festive period in general, and so there's sort of, high volumes in this September-October period anyway. Also, some of this was, a part of the increase in demand was also because when the GST rates were changed, I think people consciously postponed consumption for a period of time. So that is why that middle sort of 10 days in September, there was a dip actually in consumption. Some categories, clearly, we saw very, very strong growth during the festive period. For example, consumer durables is a sector which grew very fast. Specific brands, which can't disclose here, obviously, but specific brands, we did see significant uptick immediately after. So there has been an overall net uptick. We see this even in our part truck business to some extent.
Okay. Thank you and all the best.
Thank you.
Sachin. The next question is from the line of Gaurav Rateria. Gaurav, please unmute yourself and just mention your organization name as well.
Hi, this is Gaurav Rateria from Morgan Stanley. Hi, Sahil. I have two questions on Express Parcel. Beyond this year of integration and the market share gain and the benefit that we saw because of consolidation, how should one think about the normalized growth in this industry? Is this going to be a 10%, 15%? Any sense that you can talk about at least more from not like a very medium term, but more like a 12 months kind of a period. And second question is that when you look at the PTL, we were very confident about kind of a hitting 20% number on volume growth. First half is around 15%, and I understand there could have been GST issues that you talked about in the shareholder letter, but do you still expect it to be around 20% in a pent up demand to kind of show that in the second half? Thank you.
Sure. On the first one, very quickly on market growth and express growth. Obviously, this year there's the outsized impact of the Ecom Express acquisition. Our anticipation is that the market, as I've mentioned in the past, grows at sort of 15 to 18, 20% kind of growth rates. And earlier, of course, our point was that delivery would grow at the bare minimum in line with market growth. That said, I think there are some structural factors which are fairly significant upsides for delivery. The first, of course, is the fact that with the growth we've already seen both in the express business and in the PTL business, our cost structures improved even further. And so our ability to drive efficiency and our ability, therefore, to differentially gain share of wallet where we would like to has improved. And we will flex that muscle. So we will gain share beyond just the basic market growth. The second thing is, historically so far, one of the drags on this sector has been companies sort of thinking about doing logistics in-house. And obviously, competitors who have priced below cost. I think with the acquisition of Ecom Express, one of the things that certainly has become clear is that pricing below cost is not a viable logistics strategy. And so other competitors in this space, of course, I think have sort of, let's just say, become more disciplined, which changes competitive intensity for us. Also, I think weaker balance sheets for some of our competitors affects their ability to invest in capacity building aggressively. Also, players who have largely variable cost models, I think when you study their financials, what you can see is that there's no operating leverage at all. Even if companies in this space have been able to generate incremental revenue, they've been able to generate no incremental margins out of it. And so I think at some point that also strengthens Delhivery's overall competitive positioning a lot. So net, that's one big tailwind for us. The other, of course, is that when you look at self-logistics itself, the historical argument from self-logistics players has always been that as they grow, they become more efficient and their costs come down. I think one of the self-logistics arms has declared the same absolute loss that they declared last year. And so I think at some point, the reality is that these costs are going to catch up with all logistics arms. I think you can clearly see from one of the international marketplaces that profitability is one of their core focus areas. And what is very clear is that self-logistics is not the most efficient answer to get there. So I do think that over the next couple of years, you will also see, sort of a more judicious use of capital and sort of a decision to outsource certain parts, which are certainly loss-making, to 3PL companies, of which there aren't too many. So, there's already one fewer than there was last year. And so in that sense, I think that's again a big tailwind for delivery. So I think market growth, like I said, 15 to 20%. Delivery's own competitive positioning, evidently stronger than it was last year. We should be able to grow beyond market growth as well. In terms of PTL, yeah, 15% is where we are for H1. You're right, there's a significant impact actually of GST over here because shipouts were delayed and pushed out towards end September. This year, at least so far, we have seen a reasonably, sort of strong October. And the Jan-Feb-March quarter usually is the high water mark for PTL. I think we'll be very close. We'll probably get to the 20% growth rate overall. The other focus from our standpoint, of course, on the PTL business has also been continuing to improve our yields. So you can see, I think our yields are up again 3% quarter on quarter. And overall, I think we've gained nearly 1 rupee in yield over the last year or so, which is very significant. So we will continue to push that. I think what's more important outside of just the volume growth is for us to get to that 16 to 18% kind of service EBITDA margin. And once we get there, for us to push growth on the PTL business is not particularly hard. So no structural change even from a PTL growth standpoint.
Thank you. All the
Thanks.
best.
Thanks, Gaurav. The next question is from the line of Aditya Suresh. Aditya, please go ahead and request you to limit your questions to two.
Yeah, thank you. This is Aditya Suresh from Macquarie. So I'll have two questions for you. So first is a theoretical question. So in your kind of your press releases in the past couple of months, you'll have kind of referred to this peak volume metric, right, on a daily basis. I mean, I kind of look at that and then compare that with the express parcel volumes which you've seen. So whilst we're up over 30%, I mean, so the daily run rate, if I may, is more like say 2.6, 2 million parcels, right? So could you help square that in terms of like how should I think about what you report as a peak volume versus what you report on a quarterly basis? Because effectively what I was reading was that this implies a lot of slack in your existing system. Is that the correct way to think about this?
No, not really, Aditya. So for two reasons. One is there's a big gap between Mondays and Sundays, right? You deliver a lot more consignments on Monday than you do by the time you're getting down to a Sunday. So the average of, sort of 91 million divided by, 100 million divided by whatever, 30 days, which works out to some 3 million a day is not exactly correct. Because Saturdays and Sundays will be very, very low. Mondays will be very, very high. Also, that's just the way, more sellers will ship out in a fashion that goods are reaching, zone D, zone E, zone C kind of locations on Saturdays and Sundays. And so the Monday available volumes for dispatch are significantly higher. So that's one of the reasons why there's an outsized Monday. In fact, the interesting thing is that I would look at it as saying it's not a question of slack. It's the ability of the network to capacitate correctly for different dispatch levels across different days. Without a significant increase in our costs, we are actually able to deliver 7.2 million shipments on a Monday and, call it 1.2 million shipments on a Sunday. Because were we actually, if we had as much slack as the average would suggest, the reality is that the express business would be nowhere near its 16% kind of margins overall. So this is the way we plan capacity. This is essentially the way that we roster capacity. This is the way our systems orchestrate the movement of goods to the last mile.
Interesting. And just in terms of then, so obviously from a market perspective, just on express parcel, you've seen quite a few movements clearly. But if you had to frame what the market looks like today and kind of your market share, could you help us with what your current understanding is?
I think market share, very hard to put exact numbers to it, but let me put it this way. First of all, if you look at it outside of, in terms of the overall market, including all of the marketplaces and excluding grocery, I think prior to the e-com express acquisition, we were close to about 20%. Post the e-com express acquisition, we're probably closer to somewhere between 27 and 30% or so. And in terms of whatever is not outsourced, if I exclude sort of Amazon self-logistics and Flipkart self-logistics, and if you it depends on how you choose to take Valmo, but if you exclude Valmo, for example, our market share will be well over half of the market.
Interesting. Can I ask one more, Sahil?
Sure, I mean, I have no problem.
Okay.
Please go ahead.
So just on then on the PTL business, right? This is more specific. I was a bit confused that you saw better volumes both year on year and sequential. You saw better yield, but margin was down, right? So why was that the case?
Just two things, yeah. There's two reasons why that is. One is obviously, like I said, there's that 6.7 crore additional cost that we had to take during the month of September because volumes got pushed out. We built capacity a little earlier. The second thing is, by virtue of being an integrated network, what happens is that when you're building up capacity for express and heavies, a certain amount of that cost gets allocated to the PTL business as well.
Right. Okay.
So that's part of the reason, but structurally, there's no change to the PTL margins. So these will just rebound once all of this sort of washes out.
Great. Thank you.
Thank you, guys.
Thanks. The next question is from Sachin Dixit. Sachin, please go ahead.
Hi, Sahil. Thanks for the opportunity. My first question is on how do we read this 13 crore incremental revenue from Ecom Express? Uh, I mean, you have obviously stopped manifesting volume there. How are you coming up with this number? And if you really try to do like to like, how much of your revenue would actually be coming from the acquisition benefit rather than just 13 crore? It seems too low.
It's just that 13 crore is just standalone revenue for some contracts which need to be exited. So ecom was in certain businesses that delivery doesn't want to service. That will also just wash out and go to zero.
Understood. So whatever express parcel benefit is there, it's already there in the P&L. This
Yeah,
13
this
is
is
just
not a, sorry, I didn't understand that fully. This is not an express parcel revenue, this 13 crores that is there. This is another contract that they had. There's a lock-in in that contract. We are servicing it and it'll wash out.
Sure, understood. Secondly, on the margins thing that my prior participant has already asked, right? You mentioned that 15.3% service EBITDA that we delivered in EPS for the quarter will be more or less normalized as we proceed to October. But thanks to a press release, we know that only 3 million extra shipments are happening largely, which includes freight as well, are happening in October versus September. How sharp a jump can the 3 million drive through? Can you give some color what is happening?
It's very significant is what I can tell you between September and October. We do have obviously our October provisional financials, but they're not public. What I can tell you is that September plus October, when looked at together, we are well within the margin range that we would have forecasted internally. The reason why September is slightly lower, your question is good, which is that October volumes are similar to the September volumes. The point is two things. One is a lot of the costs in September are in the early part of the month, and the 104, 101 million and 107 million that we've picked up in September and October respectively are pickup volumes. A lot of the delivery has happened in the first week of October as well and beyond. So there's a certain amount of impact because of that as well. Closures in October will be higher. And also what's happened is by the time we're entering the tail end of October, some of the additional capacities that were built into September are also going to start tailing off a little bit. So the October margins will be better than the September margins as a consequence. And net, when you look at September, October, the margins will be higher than the 15.3%.
Understood. Sure. Thank you and all the best.
Thank you.
Thanks, Sachin. The next question is from Abhishek Banerjee. Abhishek, request you to unmute your line.
Yeah. Hi. Am I audible?
Yeah, go ahead, please, Abhishek.
Yeah. So I just was trying to understand the jump up in employee expenses. Right? Is that going to stay or will it normalize? I mean, are there any one-offs there?
The jump in employee expenses is directly linked to the growth in volumes during the peak period. So we did whatever, nearly some 35 million more consignments in the express business and 20,000 more tons of freight. So we have more, delivery riders. We also opened a few more centers across the country. So, and we expect volumes, as I mentioned, October volumes have remained very strong. Our forecast going forward also at the moment at least continues to be pretty aggressive. But manpower levels, staffing levels across the company, and the operations teams are modulated to whatever is the overall volume that we expect to have. At a unit economics level, there's actually an improvement.
Okay, but I was trying to understand that, see, the estimate that you have given for employee expenses without the impact of Econ Express is about 386 crores for the quarter, whereas that number is 426 crores actual, right? So this 40 crores, is it going to go down? Are those one-off payments? That is what I'm trying to understand. And also in the shareholder letter, you've written about certain facilities where you have to continue paying the rent because there is a lock-in. By when will that get sorted?
I think Vivek will just provide the specifics.
Abhishek, you're referring to the P&L column, right? The management estimate, and you're subtracting the two.
Yes.
Correct?
Yes.
426 minus 386, the 40 crores.
Yes.
Yeah. Yeah. So that corresponds to the integration cost. So that cost will will go down. It's not permanent cost.
Understood. So
Right.
Abhishek, we can't hear you.
Take it on.
yeah, your voice trailed off.
Sorry, I think we couldn't hear you for a second, Abhishek. I'll just button while Vivek comes back. Yeah, go ahead, Vivek. Yeah.
Network issue.
Yeah, your voice trailed off. So you were answering the 40 crore cost will go away, and then Vivek was saying something when the voice
What
trailed
was the
off.
question around facilities? What was
Yes.
the question around facilities?
Oh, so that was you mentioned that you are continuing to pay rent for some of the facilities which you
Yes.
have decided to shut down. I was trying to understand by when will that get sorted? As in, how long are those contracts?
Different facilities will exit at different points in time. I think there are about 3 facilities which have a longer lock-in, which will continue beyond FY26 as well. The rest of the facilities should largely exit by end of this financial year.
Understood. So, got it, got it. So the 110 crores of additional of additional impact that you spoke about over the next couple of quarters, that already factors in these points, right?
Yeah, it factors all of these points. It factors the cost of facilities, people discontinuing businesses, overheads, all of those points.
Understood. And what would be, if one were to kind of try to model the margin going ahead? So is it, reasonable to think of a material improvement in at the adjusted EBITDA margin level in H2?
Material improvement in adjusted EBITDA margins. Sorry, your question was not clear to me.
No, I'm saying that generally every year there is a material movement in the adjusted EBITDA margin in the second half vis-a-vis the first half. Would you think something similar should play out given the timing of the ship season and all of that?
Yeah, that typically is the nature of the business. All the fixed capacity additions in the network do happen during the first part of the year, and then they get sweated better during the second half of the year. The volume momentum so far in October, as you would have seen our release, has continued to remain strong. If the volume momentum continues for rest of the months of this quarter, and anyways the fourth quarter is a peak quarter for PTL, the combination of these two, if it plays out as how it has played out in the previous years as well, it should ideally lead to the better sweating of the fixed assets, and it should lead to improvement in margins.
Understood. And the parcel yield, there's no reason to think that the express parcel yield will fall further from current levels, right?
Abhishek, we have explained this in our letter as well. It's entirely a function of parcel mix. So it's always hard for us to predict what the parcel mix would be going forward. What we can safely say is that any movement in yields that you see for the coming quarters will be a function of parcel mix. Whether it will go up or go down, it's hard to say.
Understood. Understood. No, my question was just given the fact that e-com express did not have too much of heavies. So
Yeah.
that step jump in increase of lower weight parcels would have happened. So I was coming from that point of view, but I understand. Yeah, thanks.
Thanks, Abhishek. The next question is from Achal Lohade. Achal, you can unmute your line and go ahead, please.
Yeah, good evening, team. Thank you for the opportunity. Two clarifications. One, there is a line of 20 crore in the other services EBITDA. If you could clarify what that pertains to and how sustainable it is.
Actually, you said you had 2 questions. You want to ask both?
Yeah, the second, just a clarification on this 90 crore, you kind of explained 48 crores is part of the employee cost and 42 crores is that part of other expenses? Is that the way we should look at it?
Yeah, just a second. Vivek, you want to go ahead and give a breakup of the 90 crore integration cost?
Sure, sir. Just give me a minute, huh?
Oh,
So the breakup would roughly be there would be about 15 to 20 crores of cost corresponding to facilities which are being exited.
hello. Sorry, I'm not able to hear.
Vivek, we are not able to hear you.
20, 25.
Vivek, we are not able to hear you.
So am I audible now?
Yes, you are.
Now, yes. Yeah.
Sorry, we seem to have lost Vivek. Am I audible?
Yes.
All right, let me take this. So of the 90 crores overall e-com integration cost that we have, the breakup is about 31 crores comes from exiting facilities, exiting offices, dismantling of infrastructure, and so on. About 17 crores is also from facilities, but it is in the exit of fulfillment center businesses that Ecom Express was running. About 21 crores is essentially the separation of employees. And the remaining is shut down, for example, of AWS costs as there are no further computational requirements and so on.
You mean the employee related charge in the employee cost item is just 21 crore?
Out of the 90 crores, out of the 90
crores
for the previous quarter. And as discussed earlier, the additional 40 crores that is there will also again wash out over the next 2 quarters. And that's already factored into the 100 crore integration cost that we expect to have over the next 2 quarters.
Yeah, fair point. And what about the 20 crore other EBITDA in the service EBITDA line item?
That is related to our cross-border business. That's a commercial arrangement between us and FedEx. So there's a change to the commercial structure of our arrangement with FedEx. Our 5-year contract is due for renegotiation in the early part of next year, and we are sort of reevaluating commercials. There are certain zones which Delhivery intends to service non-exclusively going forward with FedEx, and we also intend to launch our own product for economy cross-border shipping. But this is a one-time charge, this 20 crore charge.
Okay, understood. Just a clarification. So in the corporate overhead line item, 209 has become 235 crores Q1Q, right?
That's right.
Is that a new normal? Does that include this 21 crore or it's without including 21 crores? I presume it doesn't.
Some of this will also reduce. Of this overall increase of 26 crore, 2 crores is due to higher gratuity provisioning. About 2 crores is due to provisioning for end-of-year bonuses, which are part of the variable pay structure of the sales teams and operations teams in the company. That's as it is provisioned currently. About 15 crores is an increase due to tech costs. This is between AWS and GCP. The AWS costs are because we provision servers in advance of the peak season in order to ensure reliability of the systems. And some of this is related to AI initiatives which are currently on within the company. So the AWS cost levels, certainly as we decommission excess server capacity, for example, this will come down. So this is not the new normal. And overall, from a wage standpoint, which is the sticky part of this, the overall increment in wages through this period, I think, is only close to about 4.5 crores or so.
Understood. Understood. And if you could give any update on the new, business, what you are investing in is, what kind of visibility you could offer for next, say, 3 to 4 quarter, what kind of investments we are looking at or, targets?
So the two businesses are Rapid Commerce and Delivery Direct. I'll sort of break them up separately. The Rapid Commerce business is essentially aimed at direct-to-consumer brands and e-commerce with sort of 2-hour delivery timelines. We are currently live with about 20 dark stores in 3 cities, which are Bangalore, Hyderabad, and Chennai. We have just launched our first dark store in Delhi NCR as well. And I think we will launch Mumbai by the time we reach Q4. So we will be in 5 cities. As we've discussed previously, basis the current costs that this sort of form of rapid commerce entails, we believe that this is about an 80 to 100 crore kind of niche capability that will get added on to the core business over the sort of more immediate term. However, we do have, we have been working on the network design and sort of from a technology and product standpoint, how to integrate this business better with the overall delivery network. And we do believe that over the next 4 or 5 months, we will be able to engineer a material reduction in the cost of delivery for sub 2-hour delivery, at which point the size of the market becomes interesting. As of now, it's an untested proposition. The question is, if a company has the ability to drop the cost of 2-hour delivery to sort of sub 45 rupees, sub 50 rupees, the market suddenly opens up a lot more. So that's the lens with which we are looking at it right now. I think it'll be safer for me to provide a sort of more enduring estimate of the size and economics of this business sort of at the end of the financial year. But safe to say this will be an 80 to 100 crore business at the bare minimum. The economics of this business will change quite significantly depending on how our experiments with the network go over the next sort of 4 or 5 months. Investment levels in this business are not particularly large. As I mentioned, I think between the two businesses put together, our total investment levels are about 15 crores at this point in time. On Delivery Direct, we are currently live in 3 cities, which are Ahmedabad, Delhi NCR, and Bangalore. This is an on-demand intercity service. We will be expanding to another 5 cities between now and the end of the financial year. So this will be obviously some of the major cities that are missing. And then we'll also launch, I think, Jaipur and Surat sometime over the next 4 or 5 months. Again, here, our focus right now is more on the 3-wheeler and 4-wheeler segment. Part of the reason also is, I think, if you look at the 2-wheeler segment specifically, there is a certain amount of ambiguity around sort of GST in this sector. And obviously, from our standpoint, our competitive advantages on 3-wheeler, 4-wheeler are fairly high. So again, this is early days. This business is right now at a run rate of about 25-30 crores overall annually. Could be a very large business for us going forward. This is easily sort of, 1,000-1,500 crore business in the next couple of years. But once again, I think too early to comment. I think let's let the financial year play out, and then we'll be in better position to sort of comment on this.
Thanks, Achal.
Thank you.
The next question is from Aditya Mungia. Aditya, please unmute your line and go ahead.
Yeah, thanks for the opportunity. The first question that I had was linked up to the comment, Sahil, you made on delivery not now having to kind of share cost benefits with their customers. As the annual price resets happen in the month of Jan, Feb, March next calendar year, should we expect that benefit starting to flow through into our margins?
Probably, Aditya. It's too early because right now, I think we don't know what the shape of those negotiations will be exactly. And I'll explain why. Because some of the negotiations that are ongoing with some of our bigger customers also involve a shift of heavier volumes, for example, into the delivery network. Because I think, as heavy volumes have grown, and this year, of course, the growth again has been pretty sharp. I think people are reevaluating sort of doing this through their existing self-logistics networks. So it'll depend a little bit on that. But broadly speaking, Darshini, you are right, which is that I think given the absence of irrational pricing from other competitors in this market, At the bare minimum, it's unlikely that we will see very significant reductions in pricing. If at all there will be any, they will only be in response to extremely high sort of gains in share of wallet with these customers, which then of course will still be margin accretive for us.
Noted. Sahil, the second question is on the self-logistics part of your thought process. Now, we've discussed Amazon, Flipkart, and the financials maybe in the past, but Valmo has become, let's say, 60% of Misho's pie, which is a significant number. Now, would you have done any kind of benchmarking of your cost structures across the first, mid, and last mile? And if so, any conclusion that you can draw as to how can that part of business for us become more competitive and thus we kind of gain market share? In specific, on the last mile, is there a thought process emerging that it may be best for certain clients to focus on the mid-mile part of it, wherein the requirements of last mile may be very different for those kinds of customers?
Not really. I think on these sort of stitched together networks, first of all, we have done the benchmarking of our first mile, mid mile, and last mile costs broken up also and then bundled versus the cost of the stitched network. We are more efficient both at an unbundled level as well as at a bundled level compared to the pricing that we have seen in the market. There are, of course, places where stitched together networks enforce sort of artificially low rates on partners, which then result, and I think you can see this in the publicly declared numbers, that the growth of Valmo has come with a consequent increase in return rates as well. And logistics costs as a percentage of revenue have not reduced for Meesho as well. So for an equivalent profile of goods, the costs of delivering via the Valmo network are not lower than delivering through delivery. In fact, they are higher than delivery. And also when you adjust for loss and damages, our sense is that actually delivery is significantly more efficient. I think the other question also is, and again, let me be clear, I think, they built Valmo, there's a certain amount that will continue to go through that network. But the reality is that I think stability of the network has been tested during the peak period. And our service levels have held up. We also track our service levels, not just for individual clients, but we get service levels published at an industry level. And we have seen that through the months of September and October, aggregate service levels and speed for the delivery network were materially differentiated. And that obviously results in lower returns, that results in lower customer complaints overall, and so on. So we do keep benchmarking. We do believe that we have material cost advantages. There may be very, very specific sort of areas, of course, where somebody may be highly sort of, localized and better than us in the last mile. It is always possible. But that difference usually, Aditya, will not be more than a rupee here and there. And it's just not material enough to sort of, justify doing the last mile yourself and everything else through delivery. I think overall, what you will see is a consolidation towards Valmo plus, sort of a high quality player like delivery and, partitioning of the total Meesho volume between these two.
Thanks, Aditya. The next question is from Jainam Shah. Jainam, you may unmute your line and go ahead.
Yeah, thanks for the opportunity. So just one question, the announcement that we have done about the incorporation of a subsidiary in India related to the like the Delhivery Financial Services Private Limited. So how we are thinking this subsidiary over next few years? Is it going to be something big and probably we are probably competing against one of the leading listed players in this particular space, or is it just a start point and we might think about it probably after a few years?
So obviously our desire is for this to be large. That I can share our thinking behind this. There are three distinct pieces that we intend to sort of power through this. First up, of course, is the fact that we already have a large network of truckers who work with us as part of our express network, our PTL network in line haul. They work with us as part of our supply chain services business as well, and also as part of our FTL network. The objective will be to provide services to these truckers via the financial services arm. This will include, for example, things like FASTag and fuel. The second, of course, is we have a large number of partners who work with us and wish to grow their fleets with delivery, we will look for partners who can work with us and essentially enable our partners to expand their fleet, essentially lending for commercial vehicles, for our partners to do both small commercial vehicles for sort of intracity distribution and short haul vehicles, but also long haul vehicles as part of Delhivery's FTL and SCS network. And the third, obviously, that we already offer to our customers is a form of assurance or protection, essentially, against loss and damage, delays, and so on within the delivery network. So that's sort of how it will come together under Delhivery Financial Services. The business plan is something that, Mukul Sachan, who joined us recently, Mukul was the CEO of Lending Card, has come in, and he's putting that together, and we'll have more details to share in Q4 and towards the end of the financial year.
Got it. Thank you so much.
Thanks, Jaina. The next question is from Krupa Shankar. Krupa Shankar, please unmute your line and go ahead, please.
Yeah, good evening, and thank you for the opportunity. The first question was on the PTL side. Sahil, while we have seen that the underlying industry growth has been between about 10 to 12%, and we have been consistently outperforming the industry and become more or less the second largest player. At what stage do you believe that our growth will be similar to the underlying sector? And do you see that there is a logical consolidation which will happen in this sector over the next 3-4 years? I'm specifically talking about express part truckload sector. Do you see chances of consolidation over there?
Sure. Actually, Varun's on this call. I'll ask Varun to weigh in. Varun, go ahead.
So on your first question, basically, at what stage do we think our growth will be in line with, let's say, the growth in the economy, or let's say the participants in the industry? I think how PTL is different versus, let's say, express businesses. Probably we are extremely low on market share at this point in time versus the organized market as a whole. And then there is a big unorganized market where there is a lot of share with the local players, which is basically getting more and more formalized with every passing month. So I think that stage is far. What also gives us another lever versus competitors, which may be older than us in terms of the time they have been doing PTL, is our presence versus them relatively is geographical constraint still, although we have worked on that a lot over the last couple of years, and that's why you see the growth that's transforming. So as we do more and more, we go to deeper parts of the country, which generate more loads. Practically at some areas, we probably still have zero market share. So these two things coupled, I think there is at least this is not something which we lose sleep right now. That is one. What was the second question? Sorry.
So yeah,
consolidation.
Yeah.
Again, on consolidation opportunities, we do get to see various assets at various points in time. But to be very honest, we are yet to see something which we think will really benefit us in the longer run. Anyways, I think on this point, Sahil might want to add something.
Yeah, so very briefly on consolidation, I think choosing what to buy in this space is very important. There are assets which have been available in this space. In fact, I believe there is one which is currently sort of being looked at by various players. We are not part of that, but the reason is because, as an example, it's easy to build, let's call it a 300-400 crore PTL business, which is doing volumetric cargo and losing money. Now, Delhivery is not particularly interested in buying those kinds of assets. There's sort of no price at which that asset makes sense for us, because I think buying a sort of forward moving PTL network with volumetric assets is the easy part. Making it make money is very hard. And if we can't, then we're pretty certain that nobody else can. So that's number one. And I think number two, the reality is the more our scale relative to other players in this space increases, the less the relative value for us to go out and pay a very high multiple to buy, another player. So at least from our standpoint, I don't think that's the shape and form that consolidation in this industry will take. I think more likely over a period of time, these other players who are not investing in building capacity will remain flat. They will continue to have the ability to sort of make money, but not capture growth, and our relative growth will be significantly larger.
Got it. One more question from my side was there are two other subsidiaries which have come up in UK and UAE. Is it related to the FedEx point which you were mentioning earlier? More to do with the freight forwarding?
Yes, very narrowly. These will essentially just be outposts for delivery in both of these markets. I think with the UK-India FTA, this is an interesting market from a cross-border express standpoint. We're very excited about the economy product that we're going to launch now. We were not able to launch this while we had an exclusive partnership with FedEx, but now we can. And the one that is planned in Dubai is fundamentally because we essentially intend to use multiple carriers for our mid-mile. We use Air India today. We also intend to use Emirates. And so the advantage is that we have the ability to consolidate and deconsolidate cargo in Dubai.
Thanks, Krupashankar. The next question is from Kaundinya Nimagada. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Couple of questions. One on express parcel, and then on the second one is on the financial which is incorporated. So the first, let me just get over the second one first. So the financial arm which are incorporated, is it going to be something very similar to what BlackBuck does, where you become an aggregator, or are you also going to have some skin in the game? I mean, are you just going to be an aggregator for financial institutions, or are you also going to take some lending on your books? If you can provide some clarity on that front, please.
I think too early to say, and I think BlackBuck has built a great business when it comes to doing FASTag and fuel and so on. So that is something that we intend to provide as a value-added service to trucking partners on the delivery freight exchange and within the delivery network. The commercial vehicle lending, I think they also have a pretty small book at this stage. And our approach is actually more geared towards small and mid-sized commercial vehicle lending at this point, because that's where we feel that our ability to underwrite demand obviously is significantly better. These vehicles, vendors plying with us gives us a very, very significant competitive advantage, both in terms of capacity and in terms of cost. So, and the intention from our standpoint obviously will be to bring in partners who are interested in funding, fleet owners. So it's still early. I think too early to comment on exact details, but our approach will be, somewhat dissimilar from BlackBuck overall.
Okay, just to get that understanding on the last part correct, you're not going to take the risk on financial risk on your books. You'll just be an arranger collecting service fee. Is that a fair understanding?
Yes, more likely than not. That is correct.
Okay, then moving on to the other question on express parcel. So just trying to understand on this aspect. I mean, Ecom Express, in your estimate, what would their volumes be in base quarter? That's 2Q FY25 last year.
I don't have the data offhand immediately, but broadly from what I remember, Ecom Express must have been doing about 85 to 90 million orders a quarter in steady state.
I mean, last year it was a bit higher. So at 50%, so is it fair to understand?
You have to correct for the fact that there's a reporting difference between Delivery and Ecom Express in terms of the RTO rates. So you have to adjust the volumes by about, I think, 14 or 16% or thereabouts. The forward volume, which is how Delivery recognizes it, would have been about 90 million orders for the quarter.
So 90 million.
Quarter two may have been a peak quarter, so it may have been slightly higher, but go ahead with your question.
Yeah. So 90 million per quarter, and the retention rate broadly is around 60%. Is that a fair understanding?
What's your question?
So the question is, I'm trying to figure out the organic growth in this quarter, because it appears that at 55, 60 odd million parcels that Ecom has done at 50% retention rate, the organic growth is only 4-5%. So just trying to understand that math part correct.
Broadly speaking, the organic growth in the delivery volumes, let's look at it slightly differently, because you have to exclude the likes of our Meesho growth and so on. When you exclude that, our direct to consumer and SME volumes, as an example, have grown 40% YOY. Now, with the marketplaces, obviously the growth rates are significantly different. Our volumes of the marketplaces have also grown pretty significantly. So our organic growth rate, it's very difficult to sort of comment exactly what it would have been. It would have been north of sort of 15% for sure. And that would mean that our overall, as far as I can make out, our overall volume retention from Ecom Express would have been north of 45-50%.
Sahil, I mean, that's where the problem is. Somehow the math is not adding up. So that's the reason I was trying to understand the basis first before I asked the question. Because north of 15% organic growth plus then a 50% retention rate, the volume should have been 270 odd number.
No, that's not correct. We did 185 million odd consignments, so 180 million, on which if you add about 15%, you get to about 207. We've added close to about 36 million consignments after that on a base of about 85, 90, which will be about 40%. You can
Okay,
take
so
this
that,
up, you can take this up with Vivek and team after this, and they can give you details.
sure.
Andanya, we
No,
can speak in detail on this.
sure. Thank you.
Thanks. Sahil, I'll just use this opportunity to ask you one clarification. You've been talking about 16 to 18% service EBITDA margin for the PTL business in the next 24 months. Just want to understand, is that predicated on the 20% growth assumption or the growth guidance that you've been talking about in that business? Or, even if the growth is slightly lower, you believe that you'll be able to hit that number?
We will be able to hit those numbers even if the growth is slightly lower. We have a number of other sort of margin improvement measures that are underway in any case. As you can see, we've been consistently improving yield in this business as well. So we expect that those yield improvements will continue. Overall, the second is capacity utilization across the network is anyway going up. And the third is that a lot of our BD is also focused on improving the directionality, which is another way of saying increasing utilization of the overall network. So irrespective, let me put it this way, we are not predicating reaching the 16 to 18% margins in the PTL business only on the 20% growth.
Sure, that helps. Thanks a lot, Sahil. I'll leave the floor to you for any opening or for any closing remarks.
No, thank you to the Ambit team, first of all, for hosting us. And thank you to all of you who've joined on this Wednesday evening and participated in the analyst call. As discussed, I think we're pretty satisfied with overall performance in Q2, fairly significant growth, especially in the express business, and improvement in overall revenue in the PTL business, both with 11% growth in volume and 3% growth in yield. Also very happy with the improved profitability of the supply chain services business. Most importantly, I think the integration of Ecom Express, particularly, I think has been smoother than even we originally expected. I know there were questions and doubts after the spot-on integration, but I think this time around, it's been a very smooth experience overall. We expect that compared to the 300 crore envelope that we had originally thought, we will be significantly below that. So set up very well for Q3 and Q4. And, look forward to speaking to all of you in 3 months. Thank you.
Thanks, Sahil. All of you may now log off.